The session itself, I'll give a bit of an outline of how we've planned it. We'll start off with me giving a brief introduction to each of our panel members and a bit of context setting. This will be followed by just 5 minutes or so from each speaker, giving their reflections on this topic and how it relates to their respective interests and areas of expertise. This covers areas like domestic financial systems, monetary policy, debt, climate finance, and inequality, so quite wide-ranging. We'll then have roughly 20 minutes for panel discussion, followed by some Q&A from the audience before we wrap up with some final thoughts and reflections, hopefully not too late. So I'm going to move to speaker bios. Our first speaker will be Redge Nkosi, Senior Economic Advisor to the Coalition for Dialogue on Africa at the African Union and the Executive Director of Firstsource Money, a macroeconomist with expertise in monetary policy and African political economy. And he'll be speaking today on the importance of building domestic and state banking monetary systems. We then will hear from Manswanele Nishwanti, a senior researcher at the Institute of Economic Justice, who we're hosting this event with, who works on how the international financial architecture fuels debt crisis, bringing expertise on the role of local currency financing to tackle the debt crises, and insights from the recent G20 process, which was held in South Africa last year. We then have Pepukaye Bardouille, the director of the Bridgetown Initiative and special advisor to the Prime Minister of Barbados. Pepukaye has been at the center of efforts to scale climate finance and reform the international financial architecture. We hope there'll also be reflections on COP30 last year and the Bridgetown's initiatives and their current priorities and how it intersects with building momentum for local currency financing. And finally, we have Fernanda Balata, who joins us. She's a political economist and associate fellow at the New Economics Foundation. Fernanda's work bridges global South and global North efforts to reform the international financial architecture. She'll also speak about issues of entrenched inequality and the G20's historical role, and what meaningful solidarity from global North actors could look like in this context. Okay, so some framing discussion points that I just want to begin with. Across much of the global South, governments are being asked to finance climate mitigation, adaptation, and development at the same time as facing intense pressures to service foreign currency debt. At the heart of this is an unequal global monetary system that entrenches dependency on foreign external currencies. This system is far from neutral. It reflects long-standing asymmetries with roots in colonial monetary arrangements, but also continues to shape the economic paths available to many countries. In practice, this often pushes economies towards extractive and carbon-intensive models and locks governments into crisis-prone debt cycles, limiting their ability to invest in climate and development priorities on their terms. I think crucially, underlying all of this is it really determines who bears the cost of adjustment in a crisis, who gets access to liquidity, and who has the privilege of issuing so-called safe assets. So with this in mind, the conversation today is particularly urgent. Given the broader economic context, we know that high global interest rates have pushed debt servicing costs very high for countries into crisis levels we've not seen before, and the gap between what's promised for climate finance and what's actually delivered continues to grow ever larger. Positive Money's recent report on Beyond Dollar Dominance looked at this unequal currency and racialized hierarchies and how they intersect to shape the global financial system. And we're really grateful to have such a great panel here for us to look at how this has been put into practice, what emerging solutions are out there in terms of local currency financing and beyond that are gaining traction. We understand that this isn't a silver bullet to solve all the problems, and there are a wider set of institutional and economic and political pathways that need to come alongside with this. So today's conversation is an opportunity to reflect on that and on the broader debate of how to reform the international financial system. I'm going to hand over to our panelists now, who will have expertise across the board in many of these areas, including climate finance, international debt, advocacy, and global South-led reforms. So I'm going to start off with Redge, who's going to speak, as we said, on the sort of domestic context to this.
Yeah, thanks, Denisha, and good evening to you all. And my name is Redge, as introduced. Yeah, we find ourselves here tonight discussing local currency financing, essentially because we are caught up in financial architecture that came, to be around in 1944. The United Nations Monetary and Financial Conference, commonly called the Bretton Woods Conference, gave birth to this architecture, essentially. There were two opposing views at that time, one from the UK and the other from the US. And whether fortunately or unfortunately, the US proposal prevailed. It was more of a political matter than really economic. Now, the question that emerges is that since 1944 up to now, what has been the cost, or what has been what have been the advantages of this system, this monetary system, since the post-war, in 1944, 1945? We find that Africa and the developing world are caught up in debt as a consequence of this financial architecture. The economy's macroeconomic positions are quite shaky as a result of this. Debt is quite high, and vulnerabilities to the economies are essentially very, very high. But also, it is also beginning to, I think, stress the very countries or the very country that initiated this idea, the US. And of course, allies like Europe and so on are beginning to see how dysfunctional the monetary and financial system that we have today. Now, the British proposal, well, rather the American proposal, was around creating the US dollar as the supreme currency reserve. Therefore, to obtain that reserve, you really have to export a lot and do all manner of financial tricks, some of which could not easily be done by the developing countries, including the continent of Africa. Now, the second proposal, which came from the UK, was based not on any state currency. It was a neutral currency, the banco. That one was to be the currency that each one of us would use, but nonetheless maintaining our strong domestic base in finance. And unfortunately, it could not be accepted. But technically, it seems to be one of the best ever drawn plans or proposals with regard to how the global financial architecture ought to be. Now, I remember Keynes, the British economist who was the head of this, was heading the British side, once said he sympathizes with those who are rather interested in minimizing the economic entanglements rather than those who seek to broaden the economic entanglements among nations. In his view, he thought finance ought to be primarily national. And it's indeed from this perspective, from his perspective, that we now talk about local currency financing, meaning bringing back the idea that was discussed in 1944 of financing economies from our local currencies, not dependent on the US dollar. Now, the question is, how good is this system of financing our economies from our local currencies? There are advantages, of course. One of them is that you avoid or you reduce the exchange rate risks that we know Africa and the rest of the developing world incur or have or seem to have, at least from the perspective of the advanced countries. With the local currency, therefore, you're able to reduce those risks. But I think much of the borrowing today is in the US dollar, isn't it? So the debt that arises from that is quite high for at least countries like ourselves in the global south. Maybe for those in advanced countries, it's a lot easier because they can somehow finance themselves in their own currencies. In our case, not. So there are quite a few advantages indeed. Outside of that, financing locally or using your local currency gives you some economic sovereignty or monetary sovereignty, which is what Africa lacks. Therefore, the need for us to begin to do that is, quite frankly, quite high. And we think it is an option for Africa and the rest of the developing world to attempt to begin to finance their development through their own currencies. But that's not the end of the story. You can finance your own development through your local currencies. What does that mean, essentially? Does it mean that you can buy equipment, that capital equipment that you don't have in your local currency? It becomes a challenge, though. Even if domestically you can produce, you can manufacture items that can be sourced from within your region or your country, it becomes a challenge. Somehow you still have to source some financing from elsewhere. That's where we draw in or bring in issues of multi-currency systems, where we have to have payment systems in the continent or in the global south. Instead of us having to use the third currency like the US dollar, we have to exchange our currencies directly. That becomes part of the arrangement of using local currencies. And indeed, this is happening in Africa through the Pan-African Payment System. We see so many countries participating, and I think this progress is being noted. But some did ask, but which other countries are doing this? China principally has been operating from a local currency perspective for quite a number of years. Not just China. We go back to Germany, they did the same thing. Japan did the same thing, and a few other countries in Asia. So it seems to me that there are lots of advantages to financing production or development as a whole using local currency. But is it a panacea, we may ask? The answer, I say, is not necessarily. It may not be a panacea, but also it depends how you construct this local currency scheme that you want to operate. I would propose here, perhaps if we're going to have economic sovereignty in Africa and the rest of the developing world, that we should avoid local financing where it is market-based. The proposals that I've seen from our colleagues in in the global north, mostly in the UK, English speaking, they tell us that, well, no, you can have market-based financing of your production using local currencies. I may caution that that is not easily possible. China, up to now, have not allowed themselves to be subjected to market practices when financing locally. Therefore, for me, while we must advocate the case for local financing, as advocated by leading economists like John Maynard Keynes, the trick lies in the way we construct the local currency financing scheme. The first part, as I said, is that we should have our payment systems from where we don't have to depend on any currency outside of our own currencies. The second is that this particular local financing ought to be necessarily bank-based, not market-based. To me, that is the bottom line. Otherwise, the economic sovereignty connection between local currency financing and indeed the monetary sovereignty that we wish to have melts out completely, should we not be cautious. One final point, we cannot have local financing without capital controls. There's no need for any country to open up its capital account. In South Africa, for example, 90% of the debt is in local currency, but we experience significant volatility in the rand. Other macroeconomic vulnerabilities are there, but we finance much of our debt is in local currency. It is in this context that I want to warn developing countries, whether it's South Africa itself and others in the global south, that the system that South Africa operates in, where it is market-based, is dangerous. And we need to have capital account closed. China's capital account, up to now as we speak, is completely blocked. And unless we do these things, local currency financing is not going to be of any help at all. Let me close off now. I think my 5 minutes is off and allow others to do so. Thanks very much. I'll come back a bit later.
That's great. Thank you. There's lots to pick up on there. So we're moving to Mazwanele now. Thank you.
Thank you so much, Danisha. I think you can hear me. And thanks a lot to Redge. I think that was quite a chunk of a lot of ideas that we could explore. I just wanted to start off with perhaps some of the work that the IJ has been doing in this area in terms of debt justice, as well as local currencies, as one of the ways to which we can confront the debt crisis that is confronting many of the developing countries, particularly in Africa. And one of this was to highlight the idea of invoking international human rights norms in the debt restructuring processes to ensure that we are able to sort of look at the debt crisis as a developmental crisis, which then means that if you find a lot of African countries defaulting on education, on debt, on education, health, it means that, for instance, we are renegating on the international human rights to take a number of people to school, as well as meeting our health goals. Another thing I think, for instance, Redge was touching on is this idea of sovereignty, and we're linking this to also climate crisis, to say that what would sort of, because of debt sort of hollows out the policy space for developing countries, and therefore are unable to invest in infrastructure. They are also unable to invest in climate responses and mitigation and so forth. We need to create a policy space where these developing countries are able to gain their sovereignty through, of course, in one, financing their developmental imperatives through local finances, by developing, of course, capital markets. I think also, just because Redge has already mentioned the idea that, of course, this idea of dollarization or most developing countries having been entrenched in this international monetary system, in the way that the international financial architecture is set up, it also means that they are exposed to exchange rate risk, but they are also very much entrenched into or exposed into the interest rate risk as well, which then renders monetary policies in many economies useless, because they have to follow what the Fed does in that sense. So which means that countries do not have monetary policy autonomy. And in many ways, then they respond to whatever the dollar is doing in that sense. This also cripples institutional arrangements in countries insofar as financing is involved. For instance, if we look at the Ghana debt crisis, they were exposed, of course, or the crash was due to the collapse of their currency. But that also meant that they had no monetary autonomy to deal with that challenge, and therefore were left wanting. Another issue that we can also look at is, of course, the credit rating agencies, which sort of increase the risk premium for developing countries, and this sort of also then makes the developing countries unable to finance their development and closes them out of the capital markets. The case for Zambia, for instance, being downgraded during COVID-19 does again link to this idea of us whether we link our challenges to development or we link our challenges to the climate responses. And this is one of the proposals then we were pushing for was the debt standstills when countries are going through debt restructuring processes, so that you are not then caught up in a situation where you are unable to meet your human rights obligations or your developmental imperatives. I think in sort of like closing, and maybe we're moving forward in terms of how do we recapitalize the MDBs, and particularly maybe speaking about regional or local ones in the case where we're thinking about local financing. To make sure that we capitalize them with different multi-currencies so that we're able to then fund a lot of developmental projects. And this also speaks to how then nations as well as regions develop the monetary systems that are going to be able to respond to developmental imperatives and gain their sovereignty.
Thank you so much, Ms. Winelli. That's really a great kind of overview of how it affects debt crises and debt justice. I'm sure we'll come back to some of that. So we are moving on to Pepukaye, and your focus will obviously be climate finance and what's going on with initiatives at the moment.
Thanks very much, Danisha. Much appreciated, and really appreciated the interventions of the colleagues who've just spoken at length and more importantly at depth on local currency. I'd love to jump in with a couple of observations there. But maybe just taking a step back to kind of look at climate financing generally. I think we often intuitively understand that we need financing for mitigation, adaptation, and loss and damage. But until and unless we get into the kind of specifics of that, I think we stay very much on the surface, and it's hard to remain optimistic about what's going on because we are, just kind of floating over the top, and the numbers will never add up to what, or are not yet, let's put it that way, adding up to what it is that we're calling for. So just quickly on mitigation, I think there's a very strong and importantly positive story to be told, particularly as relates to the increase and the scale up in clean energy, both in terms of dollar figures and investment, as well as the addition of hundreds of thousands of megawatts in this case up to 4.5, maybe 5,000 gigawatts of new renewable energy will be added worldwide by 2030, right? So these are important numbers. And just to put this in perspective, last year, if the research I've done is correct, there's something like $3.3 trillion of investment in the energy sector. Out of that, 2/3, precisely 2.2 trillion, went into clean energy. So I think that's a very important piece of the equation to speak to, because that draws very much on private finance. And so when we talk about private capital mobilization, I mean, here's a perfect example. In most of these instances, I would say that, almost all of that money raised would have tapped private capital markets. The question is, and this will come to local currency in a minute, is that international capital markets, domestic capital markets, and how do we actually see local currency as a pathway to financing these types of investments? And I also think there's a very positive story to be told in terms of the business leadership of a handful of countries, particularly China, because China is pushing ahead on power, so on sort of the generation side, on batteries, and obviously on electric vehicles, where I think we've seen some numbers around BYD, overtaking Tesla as the largest car manufacturer in the electric vehicle space. So these are very important stories to be told, because you are producing the technology that small island developing states, small and large island and non-island states on the African continent and in Asia and elsewhere will benefit from that continued focus on clean energy because it pushes down the costs. Now, I think we're seeing some really interesting movements in metals at the moment. All metals, gold, obviously everyone's seen, but silver and copper, good for Zambia, not necessarily good, for the power system. So I think we're going to see some price volatility, but there's still a huge price advantage. My concern on the mitigation side is AI and what is going to happen with the growth of AI, particularly the push for data centers and to what extent that starts to erode the clean energy scale up. And actually, you have a lot more rapid build, gas fired or even fossil, sort of less clean fossil fuel fired generation. But let's leave that in a box. The question for me on the mitigation side is, in the current geopolitical context, is China going to take a political leadership role as well as a business leadership role? And I think that's very important messaging because that also determines what money flows where and who borrows from whom for what. If we get into adaptation, look, unfortunately, the numbers are nowhere near where they should be if you believe official statistics, right? So UNEP will say it's in the low, maybe middle tens, 20 or so $billion in 2023, it decreased in 2024. There's not enough money going into adaptation, but I think here's the problem. It depends on how you're defining adaptation. In the leadership role that I have within the Prime Minister's office on our prosperity and resilience investment plan, almost everything we're doing is adaptation, be that ports or the airport, right? Ports and logistics, which are core to having enough food and other supplies in the event that you're hit by a hurricane, be that in terms of Barbados serving as a critical linchpin or point for providing services and inputs to other Caribbean islands in case Miami gets hit. That's adaptation, right? We have a target in our investment plan of homes being built or rebuilt to Category 3 hurricane standards. That's housing and it's adaptation, right? Every time we fix roads so that they're not affected by flooding, that's adaptation. So I would argue that when I sit with the Minister of Finance and look at our budget for the year, a whole chunk of it is adaptation. And so when we look at these numbers of billions of dollars, I'm not sure that's correct, right? Because Barbados's budget, we have an $11.6 billion investment plan, so about $1 billion or so a year, out of which 50–60% is adaptation. That's a country of our size alone is $500 million. So I don't know if the numbers are accurate and if we're really understanding at a granular level what adaptation means for people, for countries, and for governments making investments. Now, does that mean that we don't need more money? Absolutely, we do. And Bridgetown will continue to argue that we need more, cheaper, longer-term financing. But our ability to borrow, and this is where the debt sustainability analysis becomes absolutely critical, our ability to borrow, as in take on more debt, so that there are benefits from investment in climate, in nature, and in everything else that a government needs to do. That mindset needs to shift. And so while we talk about money, we say we need more money, there's not enough money. Let's get very granular about what that money is being used for and where it's coming from, because the private sector has every incentive to invest more. The question is, do we have the right policies and legislation and seriousness and implementation to get them to come to our countries? Which brings me to my last point, which is around implementation. And so you asked me to speak to COP. I have nothing to say about COP except that we now need to deliver. And that is we developing countries and we, more industrialized countries. We all need to deliver for sure. We need to think very carefully about what we're investing in when it comes to, bypassing in a tremendously terrifying way that 1.5 degree number, which we are going to bypass, but also a seriousness on our parts in developing countries to make sure that we are allocating and advocating for more cheaper long-term financing to fund our investment pipeline. And that means that we need investment pipelines that are credible, that are robust. We need to do the policy work, the regulatory work, and have the resources, human resources on the ground to unlock these very large investments. I can assure you right now, we can, and on the Bridgetown side, will continue to push for multilateral development banks to unlock more financing. But if they cannot get that financing out of the door and they don't have a robust pipeline, it's not serving any of us well. It doesn't serve them well because they can't meet their targets. It doesn't serve us well because we're not seeing that resource deployed into large-scale infrastructure, water mains replacement, undergrounding of power cabling, updating flood management systems, building roads, and that's just on the climate side. I'm not talking about the wider development agenda, agriculture, schools, hospitals, all of these pieces. But if they can't get that money out of the door, asking for more money is not necessarily going to solve our problems. And I think this is where local currency financing comes in. One very last point. There are over $17 trillion, and of course, plus or minus, US dollars in emerging markets capital, in developing countries' capital markets, so domestic capital markets. Leveraging those capital markets is going to require stepwise approaches, right? That money doesn't just deploy because it's sitting in the capital markets. And this is where local currency financing and pushing the MDBs, not just to have local currency on their list of instruments, but to proactively show the benefits of local currency rather than saying, yeah, we could do it if you wanted in certain currencies, right? Because it's not all currencies that are going to lend themselves to large loans. But we actually want to show the borrowing countries and the borrowing companies in the cases of the DFIs the advantages of borrowing in local currency. Yes, the ticket size may be, the sticker price may be painful to look at because a percentage at which you're borrowing is higher. But when you look at the risk down the line, you will see that it's actually beneficial because of, you won't have the same need to do FX hedging. And until and unless we do local currency financing systematically and at scale, we are not going to be able to develop domestic capital markets. And that's where we need to get to, right? Is domestic capital markets that can fund a much larger chunk of the investment portfolio of a government. So I'll leave it there, and very happy to hear the other colleagues speak.
That's very wide-ranging and great on the granular detail there for people to, the depth for people to get into in the conversation part. So thank you very much. And so we're going to move to Fernanda to talk more about inequality and the international financial architecture. You've had a report out recently, and then we can bring together all the separate kind of parts of this discussion in the panel discussion afterwards. But
just unmuting myself. All right. So thanks for having me, Denisha. And I will start with a finding from the work that I led, reviewing 2 decades of the G20 crisis response across debt, climate finance, taxation, and labor. This report was done in collaboration between the New Economics Foundation, the Institute for Economic Justice, who's represented here, and the Institute for Policy Studies, the Center for Economic and Social Rights, and Transforma, which is a think tank based in São Paulo in Brazil. So doing the review, we found a very consistent pattern that when capital markets are at risk, the G20 has been effective in mobilizing at scale, and money moved quickly to stabilize markets and to protect creditors. But when people's lives and futures are at risk, so when reform actually requires, challenging power, so redistributing power, changing entrenched rules within the system, or constraining private capital, then the progress has been slow, partial, or completely absent. And I'll give just a few examples. So we looked at the 2009 crisis, for example. We saw notably that one had a 1.1 trillion stimulus. It's hailed as kind of the big moment of the G20 when it really established itself as a key global economic governance forum. The Eurozone crisis, at the Los Cabos summit in 2012, the G20 members pledged over 450 billion to the IMF to bolster its lending capabilities during the Eurozone sovereign debt crisis. Now, that package included substantial contributions from emerging economies such as China, Brazil, and India, but the funds were channeled mainly to IMF programs in Southern Europe, not to the global South. Again, during COVID, the allocation of 650 billion in special drawing rights followed a similar pattern. The issuance provided vital liquidity during the pandemic. IMF quota rules meant that Africa, home to 18% of the world's population, received only 5% of the total. We've seen that pattern basically of really a difference in crisis response. And that really matters. It reveals something fundamental about how the global economy works. These outcomes reflect how risk, how power, how decision-making are built into the international financial architecture itself. And the system of norms and rules that are shaping and driving global economic governance is organized around a core principle that the global economy is considered stable when capital markets are stable and creditors are confident. And when that stability is maintained by sacrificing development priorities, as we've heard, just climate action and social investment, decision makers are effectively saying that this is an acceptable price to pay. And in that sense, the international financial architecture is doing what it was designed to do. So if inequality then is produced by design within the system, then reform can't be just about fixing what's broken. It really is about understanding what the pressure points are. And what the evidence shows is that many of the most harmful outcomes are not caused by a lack of money, but by how money is allowed to move, in which currency, and under whose rules. And this system is, in essence, distributing resources, but also distributing risk. And right now, this risk is falling overwhelmingly, as we've heard, on countries and communities with the least room to absorb it, not because of simple mistakes or incompetence, but because of long-standing historical and structural imbalances that are built into the system itself. So this is just to give a zoomed out picture of the system and what we found for the report, with really concrete examples of how, in particular, the G20 as a forum, largest economies in the world have kind of behaved in responding to these kind of challenges. Now, why local currency financing matters, I'm going to, in a way, be repeating what Redge already said very clearly, so I'll go very quickly, but it is a tool to help break this pattern by directly targeting one of the core asymmetries in the system, which is the dependence on foreign currencies. Many countries today are effectively forced to run their economies using someone else's money. They borrow in foreign currencies, pay for essential imports in foreign currencies, and are judged by markets on how well they earn and hold those currencies. And so local currency financing is really helping countries to make three important shifts away from that reality. So in that sense, that's how I see them kind of trying to break this pattern, and really change the rules. So first, it's reducing dependence on foreign currencies like the dollar. Secondly, it's helping avoid sudden jumps in that cost. Again, those things were very eloquently put by Redge, so I won't go into the details. And thirdly, I think the other thing that it's helping to do, it's making it possible to invest in climate action and development without being forced into austerity, because too often climate disasters or rising debt lead to cuts in health, education, or social protection. And financing in local currency does reduce that risk and allows climate investment to support stability, as it should, rather than undermine it. Now, it isn't a silver bullet. I don't think there is such a thing. It does help tip the balance away from a model that locks countries into permanent crisis management and toward one that allows governments to plan, invest, and protect their populations. And at its core, this is not just a financial reform, right? It is about shifting who carries risk, who has room to act, and whose priorities the system is designed to serve. But it can only succeed if it is supported by the right institutions and political choices. So this is just what I want to leave in the room, that, it brings me to the question I keep coming back to. Why is it that good ideas, such as local currency financing, keep getting blocked? Because only once we understand the obstacles really that we're facing, we can see what needs to change for these ideas to actually work. And importantly, what responsibilities different actors in the system have in making that change happen. And what we have heard today is that many of the technical tools already exist. What remains contested is who's allowed to take risk, right? And who's currently forced to carry them. There is an OECD recent working paper called Unlocking Local Currency Financing in Emerging Markets and Developing Economies. It clearly recognizes, and this is the OECD, right? Like kind of a dominant institution in the system right now, kind of setting many rules. It recognizes the unfair burden faced by countries lower in the currency hierarchy. It notes that between 80 and 90% of development finance is still in foreign currency. That's the majority of it, right? And that leaves borrowers to carry the exchange rate risk. But the paper then moves toward managing that risk carefully and not overwhelming markets in quotation marks. And that's not wrong, but it's just revealing that, for these dominant institutions like the OECD, policy space is often treated as a technical problem of sequencing and better instruments rather than a political question about who bears risk and who sets the terms. And political questions usually imply power shift, something that dominant actors and institutions are far less comfortable in addressing. And what often goes unasked is, why are certain societies the ones expected to absorb volatility carefully, responsibly, while the architecture that produces that volatility remains politically protected? I know that I'm extending myself, Danish, but there was one missing variable in most discussions that we also found in our report of global economic governance. And that's extreme concentrations of private wealth and power. And I think we touched, different speakers touched on some of the risks, I guess, also in driving new initiatives, or they're not new, but driving alternative ways such as local currency financing, in that we don't want to be bringing in a new kind of instrument or tool, but really not challenging those foundations of the system that have created these asymmetries, and these inequalities in the first place. And so if we treat currency hierarchy as just a technical feature of the system, we miss what it's really doing in practice. It becomes a mechanism for rent extraction, which often benefits private creditors, large asset managers, and the political coalitions that protect their interests. And interestingly, the OECD's own work unintentionally confirms that pattern. It shows that most development finance is still provided in foreign currency, and that foreign exchange risk is routinely shifted onto borrowers. So I think that if we are to move and push these ideas forward, what needs to stay front and center as local currency financing moves forward is, one, who stands to lose the rents currently earned from hard currency lending, shifts in foreign exchange, and dividends from crises. The second question is, who will try to capture new payment systems? Is it private fintech, platform, monopolies, commodity traders? Unless we have a governance that it's designed for public purpose. And what accountability mechanisms prevent local currency solutions from becoming just another channel for private extraction? And if we don't keep asking these questions, we really risk changing the tools without changing, the outcomes. And that's really what we want to see. So yeah, I'll end there.
Wonderful, thank you. It's a great place to end. We have had a question that could we share all the reports and references that people have been making? So we'll do the work to collect that and share with the audience afterwards, potentially. And that we'll do that work for you guys. I guess what I want to do is kind of just bring together some of the different disparate parts of the conversation. What it feels like is everyone agrees local currency financing, which is not new, is essential, but how it operates and how it's put into practice, and how we create the institutions and the pathways, I think that's the word that was mentioned, to put it to channel the large sums of money that really exist in capital markets, and in terms of what we've seen in crisis moments, that money is, we're able to scale up that financing in crisis moments, but it's directing it to where it needs to go. And I think you've all tried to come at that from different perspectives. So I guess one question I have is, from where you sit, we'll go sort of around the panel, what kind of particular political or institutional changes or structures you think need to happen for that to be unlocked? And yeah, if that's not clear, please feel free to kind of make that question your own. Could I start with you, Pepukaye, because you said a lot about those pathways.
Yeah, I mean, I think that, I don't know if there are changes or if it's doubling down in a couple of areas. I think on the demand side at the country level, It starts for me with a mindset around agency and sort of ownership of a development agenda at a time or in a world where I think in some instances there's been over-reliance by some countries, certainly not by all, on development institutions to guide. These institutions have very many highly specialized and incredibly, well-respected technical counterparts, but they can only add value to countries where they're operating in a very clear long-term vision and strategic direction. And we see that in some countries, right? I don't want to name names, but there are some countries that have said, listen, this is what I want to achieve, and I'll pick and choose who I use to advise me to kind of get there. But I have this long-term vision. So by no means are we sitting in a world where our countries don't know where they want to go. But I think that we have to have a longer time horizon in our thinking and in our planning. And that time horizon, to the extent that it can extend well beyond multiple political cycles, is helpful, because infrastructure development, for me, resilience is a marathon. And most project approaches are a sprint. And it's very difficult to run a marathon if all you do is sprint. And that marathon running means that you can't necessarily deliver the medals, or look, I ran 100 meters, look, I have the medal for 200 meters. You don't necessarily always, keep everyone on board. But I think having a mixture of, this is a 15, 20-year plan, and this is the stuff that we have to do across core infrastructure, and that's got to be our focus. And that's where the play around more cheaper, longer term financing, and obviously IDA countries are in a different situation. Right? I'm talking about more kind of IBRD countries. This is where we need to make a very clear case for why that financing is critical and what the returns are on that investment, not just in terms of people educated and people who benefit from healthcare and medicine, but in terms of the returns, where you have populations growing very quickly and the underlying infrastructure is not keeping pace with historical growth, let alone current growth, that's a real problem. So I think that's the demand side. On the supply side, I think the main message, and that's something I alluded to earlier, is you cannot projectize development. We are often on the developing country side, often find ourselves in situations where you ask for more money and the answer is, but you don't have the capacity to absorb. You don't have absorptive capacity. Okay, so, challenge us with that. Absorptive capacity is a mixture of having a vision, having very clear plans, doing the policy, legal, regulatory framework work, and then putting in place people who can execute. That requires us, in some instances, being apolitical, right? We're just going to put the best people in there to do the work. But on the supply side, I do think this mindset of you just can't handle it has to change. You have to maintain the need to work your way out of an institution that is supposed to alleviate from poverty and ensure growth and prosperity. That is a mindset shift. It's not project by project that you get there. And I think to the extent that countries can show very credible, robust plans and structures for delivery, development institutions need to get behind that for the long term. And the answer can't be, well, your envelope is X, so that's what you're getting. I think it has to be, actually, you need 10X. Let's find a way to mobilize that and support you in delivering. So that's really, for me, the core. You can get into the nitty-gritty of we need, do we leverage callable capital? Do we need new SDRs? But I think it's a supply and demand play that has been out of balance for a very long time. And if we can start to reframe that, at least from my humble perspective, it would be beneficial.
And just to very quickly follow up on that before I move on, do you have some really sort of concrete examples of where you feel that's been effective, that approach?
Look, I don't know if this is the best example, but I'll speak to it because it's the one that's closest to me, and that is, take Barbados, right? So Barbados is a country of what, 280,000 people. Not very large, right? What's our GDP? $5-6 billion. Not too bad, but not enormous. And so we're not, the Vietnams and the Chinas of the world, but I think there are a few things that Barbados has done right. It has innovated in some spaces. So, for example, on climate resilient debt clauses, debt pause clauses, as we call them, it's innovated on debt swaps. And it has shown that innovation can lead to the unlocking of capital that will go into priority investments. It has also been very clear in saying that out of our $11.6 billion investment plan for the next 10 years, plus or minus, right, order of magnitude, 60% we believe, if we do all the right things, could come from the private sector, but the remaining $4 to $5 billion would come from the public sector. And we intend to fund $1 billion, so 20%, 20+%, of our public investment expenditures will come from the savings that accrue to us through debt swaps. That's very clear, right? We have a view, and that is going to put us on the hook to every 18 months or so undertake another debt swap that is going to unlock between 100 and 150 million dollars. Now, do I believe that you can debt swap your way to resilience? No. Do I believe that it is a replacement for concessional finance? No. Do I believe that every country can look at their balance sheet and say 20% we can cover through savings? No. But it's a very structured approach to say this is the instrument, this is what it needs to fund, this is how we're going to do it. And I think on the supply side, there has been a huge amount of support to Barbados from multilateral regional development banks, I think primarily because of Prime Minister Motley's ability to inspire. And that's what all countries need to be doing. Right? She's very special, but all countries can do this, right? All countries can say, this is what I want to achieve, and force the hand of the partners. They're partners, they're not doing you a favor, you're borrowing from them to come along for the ride. And so I give that as an example, a very, very small, point in a very large set of resources required of what is possible. And we're not the only country. I mean, many countries have done absolutely inspirational things, but I speak to this because I'm closest to that particular case.
No, that's a great example for us to all kind of think about. Sort of gonna carry on with the panel discussion for a bit longer before we move to Q&A, but following on from that part of the discussion, it'd be great to know from the rest of the panel what kind of specific so we've talked about local currency financing being quite crucial to everyone, but the way in which it's put into practice is very important, and particularly around the issue of who bears cost and risks. And so what I'm interested in knowing is, in your different contexts from the work you do, what kind of examples you have of how to alter that equation of between borrower and creditor effectively. Does local currency financing do enough of that work of putting rebalancing that relationship between the borrower and creditor, which has become so imbalanced under the current kind of global monetary system, as Redge pointed out, from decisions that were made historically? Is it a solution to that, or does it have to come with other institutional and other changes? And I know people have hinted in their talks, Maswanele seems to want to jump in, other ways of other kind of things that have to come alongside it, sort of like changes politically to the human rights, changes to, which institutions. So this is a very broad question, I guess, but wherever you want to come in on that would be great.
Let me chip in.
Okay.
Oh, okay. Thanks. Yeah, I think it's an important question. Institutions, if we're to depend on local currency financing, that quite frankly, the way it is organized becomes very, very important. I think it touches on the question that Fernanda was just asking: who benefits at the end of the day? Should we have local currency financing? Who are going to be the beneficiaries? That's why I was saying earlier that there are two types of local currency financing. You have a local currency financing that says it is any local money. Whether that local money is owned by a foreigner or non-foreigner, is still local money. All right? But there's a danger in that. And what our European intellectuals are trying to put to us is that it should just be local currency. We say no, it has to be domestic local currency. I hope that differentiates from just local currency. In other words, I, as a South African, got to participate. My money, from a South African perspective, has to be put in a capital market that essentially is domestic and finances, and therefore money saves South African society, not money being sieved away or taken away, the same local money, local currency money being taken out through other channels to finance Europe or to benefit Europe or the USA. All right? So unless we begin to understand these channels, it may as well be a lost case, even if it's going to be local currency financing. Again, let me bring you back to South Africa. We have in our bond market close to about 32, there were close to 40% of the bond market being foreign. All right. So essentially, if this foreign group was to decide at some point in time to pull out these funds, then we have a problem in the system in South Africa. So macroeconomically, we're not going to be okay as a country. Okay, so we are saying if it is local currency financing, we have to have a domestic banking system essentially owned domestically. Most people assume banking is very difficult. You have to have so much money it's not. All right. It has to be domestic banking system owned domestically to the service of the society locally. That's the starting point. The second point is now, if it is domestic, what about region? So you have regional arrangements within the locality, say in Southern Africa or in Africa, that tie themselves together to this arrangement where money rotates around that particular region without having to be bombarded by money that comes in, the footloose money that comes from Europe and the USA, taking advantage of the high rates. And when that money is localized, you actually see that the interest rates themselves go down. And therefore, the community, the society, local people benefit. So we have regional arrangements springing from the domestic arrangements. And then at global level, then we have what Keynes proposed at the international clearing system. Now, examples again of some of the institutional changes that China, or institutional arrangements that China has made, or much of Asia did make. Until recently, the local bond markets in China was 5% foreign, 5%. So even if they were to play games, it will have meaningless effect on the Chinese macroeconomy. That's precisely the type of arrangement we seek to put in place in Africa, in the developing world as a whole, such that then we are able to freely enjoy economic sovereignty and monetary sovereignty as defined. So for me, therefore, the beneficiaries, remember, money is a public monopoly. It cannot be just for one or two countries or one or two persons, Bill Gates and Elon Musk and stuff like that. It cannot be like that. It is a public monopoly. It has to be a servant for the people. In that context, therefore, these institutions that I'm talking, domestic banking system, regional banking systems, collaborating, and at an international level, an international clearing system ought to be in place to sustain this local currency financing, such that therefore we enjoy the monetary and economic sovereignty that comes with it. Thanks very much.
Great, thank you. And just extending that kind of to Mazwanele and Fernanda on the institutional kind of side and changes that could drive forward local currency financing.
Thanks, Tanisha. I mean, I don't think I can add much to what Redge was saying. Precisely what really you would need in terms of arrangement to ensure that local currency financing, there's an increase in demand for local currency financing, because really what you have is and what you benefit from is the population. So you need the movement of the local currency within the domestic economy as well as the regional blocks to ensure that there's created demand for that. But you also need to develop these institutions, such as, for instance, what is being developed via the African Continental Trade Agreement, which is passed, and you've got a similar liquidity pool in the Asian market where you are able to tap into that pool for you to finance your local projects. And you can find that there's now beginning to be increasing arrangements between regional partners in terms of payment settlement. This also not only increases the demand for the local currencies, but it also reduces the cost for transactions that are being made. And it can also increase the strength of the currencies and therefore can attract investment. But I think in one of the questions that you were asking, or rather even Fernanda was sort of posing this, one of, again, the important things about the local currency financing is that then the currency exposure is not only borne by the debtor, but also the creditor, because and this now sort of puts a basket into the risk that the country that is borrowing is sort of under pressure to safeguard the strength of their currency, but also the creditors as well, because what has obviously happened over the years is that all the creditors have said that we'll borrow in dollars because this is the safest currency, which has also exacerbated capital flight in developing countries. So what now, one of the institutional arrangements, for instance, that are coming into play is the Borrowers Club, or the debtors platform, where the debtors are therefore able to pool not only ideas, but also arrangements and negotiations when they negotiate with creditors, to be therefore able to say that to strengthen your position as a borrower, to be able to say, actually, this framework, for instance, if you are going to borrow to finance energy transitions, and to make an argument that we will acquire this capital as a region, SADC, for instance, in the case of South Africa, and therefore it will be financed in this one of the local currencies, because we've got these institutional banks, and therefore we'll be able to channel the funds between the different countries in the region in this manner to make sure that we are meeting our developmental imperatives. But lastly, again, local currency will be very much tied to energy, manufacturing, as well as agricultural sovereignty. And this is one of the papers that, for instance, this is one of the things we're discussing in one of our papers, to say that because the exposure also comes from earnings, from tax, and the transaction costs. So how countries then are going to then be able to then manage this idea of exporting and importing in a dollar, for instance, as opposed to their local currency. So that institutional change as well, from, for instance, in the Department of Trades and Customs and our revenue services, is going to then begin to increase that demand for domestic currencies, such that you have got an appreciation generally, and you reduce the risks that are associated with currency exposures.
Thank you, Ms. Vanelli. That's very important. So we've had some sort of discussion just around the panel discussion up here right now. We've had discussion about who bears the costs, and actually Fernando was pointing to the winners and losers. If we do shift more towards using local currency much more, there's going to be winners and losers, and that could make it very hard for local currency financing to take off if the losers are private capital, private finance that currently gains so much from the current system. Redge, you've talked a lot about building domestic capacity and domestic local currency financing, which I think is very important to sharpen the discussion. And Mazwanele just right now talking about linking it also to domestic, key domestic sectors like energy and industrial development, which I think are all important elements to this conversation. And it shows that local currency financing on its own is not a silver bullet. It's very complex. And I think also from Pepukaye's conversation is it also varies across regions and countries. There are very different capacities and scenarios in which it can be effective and maybe not effective. So it's also quite granular. And she talked a lot about strategic vision of leaders, which sounds like I'm rounding up now, but I want to move to a couple of questions from the chat. So the first one is actually broadening the discussion out a bit more, I think, where someone has asked, Iago, PhD candidate from the Institute of Economics at University of Campinas, Brazil, who's actually written a blog post for Positive Money, an excellent one recently. He wants to ask your views on strengthening existing new international financial institutions or creating new ones, so new financial institutions and innovations, I guess. And does that have the capacity to enhance the position of Global South countries to pursue sustainable development policies in their local currencies? And what are cooperative regional South-South solutions, I guess, moving away from traditional Bretton Woods institutions. Very long, I can repeat it if you need me to, but I think what he's getting at is new financial architecture that can support this shift, and also what outside of the traditional Bretton Woods institutions could be effective for us to have a look at. I maybe start with Fernanda, because we didn't get to speak to you last time.
Yeah, I mean, hopefully I'm kind of responding to that question. But I did want to say, I mean, to follow from Redge and Moswa, because, you know, they are bringing kind of rich examples of how, you know, in the African continent context, you know, there is an emerging, you know, source of really challenges to, you know, really not just ideas, but practice examples of how they are building self-led built like infrastructural power, you know, rather than rely on incremental fixes. And I'm really interested, as I said, on this, you know, the kind of theory of change, if you may, of how, you know, we have so many good ideas out there, and I mean, Redge took us back to Keynes. You know, it's not a lack of ideas, really. You know, I think what we need to move towards is really putting ideas into practice and really understanding what are the levers we have to really, you know, make those changes happen. Be very cautious about not reinforcing really what is creating, you know, the kind of extraction and, you know, undermining really social and environmental goals and sovereignty, and, you know, and really combining forces. So, you know, we talked about how local currency financing needs domestic banks, you know, strong domestic institutions really to hold that. And then you take to another level, you know, you need a kind of regional, we talked about south to south cooperation around this. And I really like the idea of monetary pluralism, because it captures this well, in that you're not just replacing the dollar with a new hegemon, but it's about building a more resilient multipolar system where countries are not structurally punished for financing their own development. And it really puts solidarity into practice as well, because sometimes we use that word and we don't really know what we mean in practice. Now, there are real constraints to the design for, and we've heard all those, and actually the OECD paper really acknowledges that. But these constraints, they need to be understood in today's context, right? So official development assistance declining, not expanding. Major donors pulling back or redirecting funds toward narrow strategic interests. And under the current US foreign policy direction, I mean, we're talking about the dollar and the dominance of US power, right? We're seeing a more explicit retreat from multilateral responsibility and a willingness to weaponize finance and trade. And, you know, we saw Mark Carney's, I'm in Canada, by the way, at the moment, so I'll reference the Carney speech at Davos this week, you know, talking about the rupture in the rules-based international order, and the assumption that countries can rely on stable, predictable external finance is no longer credible. And we need to use that space. You know, the political space is opening for these sort of alternatives. In that context, building local and regional financial capacity is now essential. It's no longer radical and realistic, right? So now we need to move beyond trying to make a case for it, you know, and really reinforcing it and connecting. And I really appreciate what Denisha and Positive Money in the UK is doing in terms of really connecting these conversations, because I think there is a really important role for the Global North. You know, Global North actors, not just governments, but, you know, everyone sitting in the Global North. You know, and one of the conclusions from our report, it is that Global North actors, they need to stop positioning themselves as architects of reform, right? They need to start taking responsibility for dismantling those constraints that they help to build, and mostly continue to reinforce, even unintentionally sometimes. And that means, for example, absorbing more risk onto the balance sheets of multilateral development banks, reforming capital adequacy rules, reducing reliance on credit rating agencies as gatekeepers, and I think there are alternatives to credit rating agencies as well that African is pioneering. Defending self-led reforms politically when capital markets or elite interests react negatively, because those are forces that we're fighting against if we want these projects to succeed, and we need to be honest about that. And the tension that we often see between justice-led demands and institution-led calls for careful sequencing, it's not neutral, right? The sequencing and the absorption capacity are political choices about who is allowed to take risks and who is expected to act under restraint. But that's very much exposed in the world we're living in right now, and we need to really talk within that context.
That's an incredible vision for us to be discussing at the moment. So thank you, Fernanda. That's really great. And I really appreciate your focus on power structures underneath all of this. That's really important. Redge, I have a question that feels like it's directed at you, and then maybe we'll have to wrap up after this. But it's a question about what are some examples of effective capital controls that a country in the global south could take to tackle the debt crisis that wouldn't frighten investors and cause capital flight? How could we enact them? I'm imagining this might vary in different contexts, but maybe you can speak from the South African context.
Well, thanks again. The question is quite loaded also in the sense that it uses the word investors, all right? Because there's this understanding in neoclassical economics that Africa or the developing world do not have sufficient capital. Therefore, they need FDI. All right. So frightening investors means frightening FDI going into the developing world. Actually, if the participant was to look at what Professor Jun Han Jun, this Korean who was at Cambridge, now is at SOAS, says that East Asia blocked FDI. All right? They were highly selective. In other words, the so-called investors whom we're trying to pull in and out, they're essentially not investors. They are people who simply want to make a quick buck and run out. All right? Now, so the question here says, so what are some of the capital controls? They would differ from region to region. But for example, Malaysia, not long ago, even against the word from the IMF, imposed capital controls. Unnecessary footloose money coming into Malaysia was blocked. The IMF protested. Mahathir Mohamad, the former prime minister, said, forget. And fortunately, Asia or Malaysia boomed as a consequence of that move. So, it really depends on which regime that applies what sort of capital controls. But broadly speaking, we don't need hot money coming into any one of the developing countries. Hot money intended simply to vacuum resources away from the developing countries to the north. Yeah. If capital controls could be lessened on strategic FDI, which has significant technological impact on the recipient country, that would be fine. But the rest of the money can be sourced domestically, and investment can be done domestically, and research has to be done domestically for new industries to come. All we need is local financing. So I would really think that
I'm going to have to round it up because we've come to the end.
Okay.
Yeah,
Right.
I think we can carry this conversation.
Just one word with regard to whether we kill the current institutions like the IMF and so on and so forth. I think there's a theory called institutional inertia. These institutions are unlikely to change. They'll continue to serve the interests of the West. And therefore, their existence is an anathema to the developing world. They should be killed. I think the efforts that BRICS is doing, coming up with the new institutions, the better. We cannot continue to serve the very persons who have benefited from us. I want to continue to benefit from the developing world at our expense. Thank you.
Thank you so much. That's a great place to end it. Just to, because we're finishing now, but to round it off, I think there's just such incredible breadth of and depth of conversation here that we can pick up afterwards. We will share the recording of this and the reports and work that you've all mentioned from your respective areas with participants. And just to note that we talked about such a wide-ranging number of things: strategic vision, innovations in institutions and financial architecture, theoretical underpinnings and historical underpinnings, power structures, and across debt and climate justice equally. So thank you so much to all the panel members who are outstanding and amazing, and to our audience. I believe we've gone over time, so we're going to get kicked out, but thank you very much.
Cheers.